Some investors choose HYLD, others prefer HDIV. However, increasingly income investors are choosing both, and today we're going to break down exactly why these two ETFs work so well together, what makes them Hamilton's true dynamic duo. Hold on to your seatbelts, folks. This is going to be a good one. Income investors in Canada love ETFs that keep things simple, steady payouts, clear strategies, and a structure that doesn't require hours of research every week. And that's exactly where Hamilton has carved out a niche. Instead of building single sector products or stock-specific portfolios, HYLD and HDIV, they bundle together multiple income-focused ETFs, and then they enhance them to deliver higher monthly income. Now, before we go any further, we do need to clear up how these two actually generate that yield. HYLD and HDIV, they do not write covered calls themselves. That work is actually done by the ETFs inside their portfolio. What Hamilton adds on top is a modest amount of leverage, usually around 25%, which of course, well, that boosts both the exposure and the income coming from these underlying covered call ETFs. So the structure, well, it's essentially covered calls underneath, leverage on top. On the surface, HYLD and HDIV, they look quite similar, but the magic comes from where each one operates. HYLD, well, they lean heavily into the US market, tapping into the income engines south of the border. HDIV, on the other hand, they keep things anchored here at home, relying on Canada's more stable and defensive sectors like banks, utilities, pipelines, and those telecommunication companies as well. That combination, US firepower paired with Canadian stability, is why so many investors choose to hold them together. It creates a balance between growth potential and consistency while keeping things, well, yeah, it keeps them incredibly straightforward for both new investors and those seasoned income hunters. And of course, there's a pretty good diversification angle here as well. HYLD, like I said, it gives you that broad US exposure, while HDIV is leaning into Canada's more stable income-producing sectors. By holding both, investors spread their risk across two different economies, two different sector mixes, and two different market cycles, all while keeping the portfolio easy to manage. It's a simple structure, but yet it is surprisingly effective. A sub to the channel is the best way to diversify into some future content. I called these two a dynamic duo, and they've both had pretty solid years. But that raises an important question, and which one is Batman? And yes, the answer for 2025 may just surprise you. Before we start breaking down each ETF, let's zoom out and look at the big picture. Canada versus the United States. More specifically, how the TSX has stacked up against the S&P 500. Understanding this backdrop, it certainly helps explain why HYLD and HDIV performed the way they did, and why one of them might be wearing the cape this year. The data set we will be using for this comparison is from the opening bell on January 2nd of 2025 until the opening bell on December 10th of 2025, as per TradingView. Also keep in mind this data does not include dividends. We'll start with the S&P 500. They began 2025 at 5,903.26, and on December 10th, they opened at 6,833.49. This translates into a return of investment of 15.76%. That is a good year without a doubt. I should also add, Yahoo Finance does push this US return a little closer to 16%. So you will find slight variability between some of the reporting bodies for sure. So how did Canada do? Well, the TSX opened the year at 24,821.15, and as at opening on December 10th, they were coming in at 31,207.95. That, folks, oh boy, that translates into a return of investment of 25.73%. Holy banana bread, that's quite the lead Canada has over the US. Maybe, just maybe, that bat symbol will be shining in the Toronto sky. It is easy to see that both ETFs should be having very good years, and based on the Canadian market outperforming America's, HDIV should follow suit. However, before we can make that claim, we need to jump into the fundamentals. So without any further ado, let's do this. We will, of course, start where we normally do with a little bit of surface data. All right, looking at HYLD, their current value is coming in at $14.89. They have an NAV of $14.87, and their net assets under management, that's coming in at $1.06 billion. Their management expense ratio coming in at 2.22%. All right, what about HDIV? So HDIV, their current value is $20.78, and they have an NAV. Well, exactly the same, $20.78. Their net assets under management, $1.11 billion, and their management expense ratio, 2.55%. Overall, these two ETFs look very similar on the surface, and that's definitely not a bad thing at all, and perhaps it's by design, guys. We are going to need to dive a little deeper, and I want to take a look at their construction. Let's start with HYLD and their holdings. As I said, they're holding a bunch of ETFs. So we have SMAX, and this is an ETF that holds US equities, and it's a big portion of HYLD, coming in at 61.2%. We also have QMAX, one of their technology holdings. That's also a pretty big part of HYLD, coming in at 26.3%. We also have FMAX, which are US financials at 7.6%, SDAY, some more US equities at 7.4%, LMAX giving them healthcare exposure at 6.6%, and good old AMAX giving us that gold producer exposure at 5.3%. QDAY, a little more technology, 3.4%. EMAX is, of course, giving us exposure to energy at 2.8%, and we also have RMAX in there, which is our REIT exposure, and that's coming in at 2.1%. When we take a look at this big picture, technology is a huge component of this overall mix, and it does come in at 36.2% of the overall ETF. I'll also point out that we are getting some Canadian exposure to the tune of 3.7%. Okay, so what about HDIV? Their top holding is HFIN, which are Canadian financials. This one does have a 20.3% stake in the entire portfolio. We also have HMAX, which pretty much doubles down on those Canadian financials, and that's coming in at 19.6%. Then we have AMAX, the gold producer ETF once again, so 16.6%. QMAX, exposure to technology, 16.3%. EMAX giving us exposure to energy at 15.6%, and UMAX giving us our utilities at 10.7%. We also have CDAY, which is basically a Canadian equity ETF, 7.9%. We have HUTS, HUTS, those are our utilities, 4.3%. RMAX, which is, well, those are the REITs, 2.6%. And QDAY giving us a little more technology at 2.0%. Oh boy, financials. Financials is a huge component of this overall mix, and it does come in at 34.5% of the overall ETF. I will also point out that we are getting significant US exposure to the tune of 29.8%. You may have noticed that they both hold AMAX, QDAY, EMAX, and RMAX. However, of course, there's quite a bit of a difference in the percentages on those for sure. Okay, it is time to turn that page one last time and take a look at the returns data. Okay, let's start with those dividends. Of course, we have HYLD. They have a yield of 11.75%, monthly dividend of 15.3 cents per share. Looking at HDIV, they've got a smaller yield, 9.97%, and that is a monthly dividend of 18 cents per share. Okay, let's take a look at how they did in 2025. So they're year to date. HYLD had a return on investment of 7.35%. Factor in those dividends, total return 19.96%. That's not too shabby. Looking at HDIV, their year to date, they had a return on investment of 18.27%. Factor in those dividends, total return 30.06%. It is easy to see that these two ETFs had, well, they both had good years. From the numbers, you can see that HYLD They really are geared just a little more for income, while HDIV is also geared for income, but with a little more room for some upside capture for sure. I normally like to look at longer time frames, but with the reinvention of HYLD and their recent fine-tuning, they kind of feel like a new ETF. So they got rid of course, their fixed income, replaced it with some of those Daymax ETFs. Now, I also want to point out, HDIV did a similar thing. They also had some fine-tuning as well with the inclusion of a couple of Daymax ETFs. For that reason, those longer time frames, they're kind of different ETFs, so I don't really feel that they're a fair reflection of how these ETFs are structured today. I, of course, will very much want to revisit these two next year for sure and see how that recent fine-tuning works for both funds. So, who is Batman in our dynamic duo? A silly question I asked earlier, but we gotta answer it. Well, here's the thing, maybe being Batman is not a solo thing, and perhaps together with that US and Canadian diversity, maybe instead of a Batman, we have something bigger. Nonetheless, if I have to name a Batman, it will fall back on the numbers, and the TSX beat the S&P 500, and HDIV outperformed HYLD. So look up, Toronto. I see the bat symbol in your sky. If you are interested in the ETFs that we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on our TFSA challenge. Thank you for watching, and I will see you in the next video.